Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and now we have a new monetary policy committee. The RBI has created the new committee. It's brought in some new members. The old one's term is over. But the thing is that it's not as if these new members are going to have an easy time ahead of them. There's a lot that's happening in the world that is going to have an impact on inflation in India. And since that's one of the key things that the Monetary Policy Committee has to look at, they have a lot of challenges before them. But to exactly look at the committee and what the previous committee has done and how it's managed to combat inflation, and also what are the challenges ahead for the new one, to analyze all of that, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, when we talk about interest rates, most people just think that it's the RBI that sets the rates.
Correct.
But it's actually within the RBI, there's this body called the Monetary Policy Committee. So could you tell us a little more about the body and its composition?
Yeah, so to understand this composition of this body or the concept of this body, let's go back to 2016 when the government introduced the inflation targeting regime for RBI. Before 2016, the RBI did not have an explicit mandate to target inflation. RBI used to look at a number of indicators. It used to follow what is called a multiple indicator approach, sometimes looking at WPI, looking at CPI, looking at exchange rate, looking at a host of indicators. So now in the late 2000s, it was realized that inflation is rising on a sustained basis, and there needs to be some accountability fixed in managing inflation, because inflation is critical for the poor and the middle income class. It is important to align inflation expectations and so on. And globally also, most of the countries' central banks were moving to an inflation targeting central bank, where the government gives a particular target of inflation to the central bank to target, and that this is the target that you have to follow.
The government would give the target to the central bank?
Yes, in most of the cases, there are various models, but in most of the cases, it is the central government in consultation with the central bank fixes the inflation target. And which is what happens in India also. Once in 2016, the inflation targeting regime was brought into force through the amendment to the RBI Act. So under that, the RBI is given a target by the central government. Of course, in consultation with the RBI, a target is given, which is, as of now, it is 4 plus minus 2%. And this target is meant to be operational, applicable for 5 years. And after 5 years, there is supposed to be another review that whether this is the target, should the range be narrowed, should the target as a whole be changed, and so on. So that is inflation targeting regime. And an important element of this regime is the institutional framework, that who will fix the interest rate such that the inflation in the economy is within the target band. So earlier, the governor used to decide on interest rate, and there used to be something called a technical advisory committee, but it did not have a statutory backing. So now, as part of the inflation targeting regime, the Monetary Policy Committee was also introduced in the legal framework of the RBI as part of the RBI Act. And so now the next question was, what should be the composition of this Monetary Policy Committee? Again, there were lots of designs and lot of models elsewhere to look at. And what was found is that there needs to be both central bankers, the staff of the central bank, as well as external members, because external members will bring some diversity of opinion. And again, there was this debate about whether external members should be more or internal members should be more. So ultimately, what we have as part of the inflation targeting regime is a Monetary Policy Committee, which has 6 members, 3 internal members, that is the RBI governor, the deputy governor responsible for monetary policy, and 1 officer nominated by the board of the RBI. So those are the internal internal members, and then there are 3 external members who are experts in the field of economy, finance, agriculture, and so on. So,
and it says so in the law that they need to be experts in these
absolutely,
areas.
that is there in the law as part of the amendment. So now, therefore, there are these 6 members. Now, these 3 members that are the external members are appointed by the central government through a search cum selection committee, and they have a tenure of 4 years. Like when in 2016 the MPC was, the inflation targeting was set up, we had the first MPC which had 3 external members whose tenure got over in 2020, 4 years. 2020, another 3 external members we had, and now their tenure is getting over on 4th of October.
And we can't have repeat members.
We cannot have reappointment, so that is again explicitly prohibited by law. So we have these 3 external members who are not eligible for reappointment. So now, day before yesterday, the government announced the names of the 3 external members who are going to replace the outgoing external members because their tenure is over.
Okay, so now we obviously are not going to be discussing the people who have been appointed because they're all experts in their own fields. But about the MPC itself, we will of course discuss. So now the mandate of the inflation target that was set, as you said, was 4% plus minus 2%. So the band of 2% to 6%.
6%, right.
Did the previous MPC, the outgoing MPC, did it manage to meet this target?
So the first MPC did manage to achieve for most of the time. That is the first MPC that was set up in 2016
to
2020, except for the last few months of 2019 and months of 2020. Of course, we know due to COVID-related disruption, inflation rose. But overall, for the first MPC, broadly, the inflation was within the target. 4%, 4 to 5%, and so on. So first MPC is fine. For second MPC, notably, there were lots of challenges because they joined at a time when the economy was already grappling under the COVID-19 pandemic, the disruption due to that. And then there was continued fresh shocks to the economy in the form of the Ukraine war, and then the Middle East crisis, and the consequent increase in the global commodity prices due to that. Domestically, there were adverse climate events leading to escalation of food prices, the trade restrictions which led to increase in food prices, edible oil prices. So it's not the tenure of the outgoing MPC was marred by a series of challenges. And therefore, there was a period, if you look at the inflation targeting regime, it says that RBI is deemed to have failed to achieve inflation targeting if for 3 consecutive quarters inflation remains above the 6% mark. So that is, this is the merit of the inflation targeting regime, that there are some accountability mechanisms inbuilt in the framework, that if inflation persists above 6% for 3 consecutive quarters, that is 9 months, then the RBI has to, the MPC, the RBI has to give an explanation to the government, to the parliament. Yes. So
and
they
this
have
happened in 2022.
2022, yes, because from January to September, 9 months continuously, CPI headline inflation was above 6%, and therefore, when the September data came out, then the RBI MPC had to call for an unscheduled meeting to discuss the contours of the letter that they sent to the parliament, explaining the reasons for the deviation from the target, what steps they are going to take, and within what period the inflation will come back to its target.
We tried very hard to get the contents of this letter, but it was all very secret. We couldn't find out.
Yes. So in other countries, that letter content is public, like in Bank of England, it is public. Here it wasn't. But yeah, so that is the case that, this period was also marked by 9 months where officially RBI failed to achieve inflation target because consistently for 3 quarters, inflation was above 6%. So 2020, it was high. 2021, it was slightly lower. Again, in 2022, it was higher. 2023, it again came lower because of decline in core inflation, whereas food inflation remained elevated. Only in the last 2 months that we've seen in July and August that inflation has fallen below the 4% mark.
Right.
So it's not the problem with the, we can't judge the success of the MPC based on this, because during this period, economy was continuously grappling with a series of shocks.
Right.
Yeah,
So now, given that this period was so uncertain and there were so many different things happening and they were also impacting growth.
Correct. Yes.
So what we saw in the MPC was that there were quite a few dissenting voices. Sometimes there'd be one, but other times there would be two people who would be dissenting against what the overall view was.
Right.
So on what grounds were these dissents?
And those are good. We need to have dissents because external members need to bring diversity of opinion. There is a central bank's view. There are the internal members' view, but then there is external members' view. They try to bring in their own opinion about what they think should be the policy rate as well as the stance.
Right.
So there is a resolution. So the governor introduces a resolution that there will be status quo, or they want to increase interest rate by 25 basis points and so on. And then if some member does not agree, then they can have a dissent to the resolution, and that dissent can be either on the policy rate or on the stance. So what we saw is that in both the MPCs, the first MPC that was from 2016 to 2020, and then from 2020 to 2024, we had episodes of dissent by internal as well as external members, but more so by external members, understandably, and mostly what the members dissented was on the fact that we are keeping the interest rate constant for quite a long time. We had this period in 2022 when inflation was rising and therefore the policy rate was raised.
Right.
So in the recent two meetings, notably both the two external members, Professor Verma and Dr. Ashima Goyal, they dissented and they said that now is the time to start cutting interest rate and also change the stance from withdrawal of accommodation to neutral. So it's very important to not only look at the monetary policy statement, but to also look at the minutes.
Yes, but that comes with a lag, right?
That comes with 14 days lag. But again, it's very interesting to look at the varied perspectives of different members. And you can understand there are some members who are more hawkish. There are some members who are more dovish on growth outlook. And they bring in these concepts like real interest rate, potential GDP, and these are very important nuanced concepts which are, there needs to be a perspective on this. And that is the role of external members. And that is one of the, the objections raised that, we've kept the interest rate constant for too long.
And high.
At high, 6.5, at a time when we are projecting inflation at 4.5% for the current financial year. That means that the real interest rate is repo rate minus inflation, projected inflation, that is 2%, which is arguably a rate which could hurt growth prospects. Right. So real interest rate should be around 1 to 1.5%, not more than that. Again, otherwise it will start hurting investment and growth prospects. So on these grounds, members contended, these two members said that, we should start cutting rates. So they were quite vocal about their dissent that, we've kept the interest rate high for too long and it's time to cut rates, or at least bring the stance from withdrawal of accommodation to neutral. But there were other instances also where, some members objected on the language, on the language of the resolution. So there are these very interesting perspectives. Once we start, tracking at the minutes of the various external members, we know what they're looking at, and it's quite interesting to get these rich insights. And we hope that with the new external members also this discussion continues, that, we don't have one singular view on growth and inflation, but we have varied perspectives on this.
So now, coming to the new committee, the new MPC that's been formed, what are now the emerging challenges? I mean, we know, of course, what's happening in the Middle East, Israel and Palestine, and now Lebanon and Iran, all of it. Yeah. But one, how is that going to impact India? And two, are there any other emerging challenges? Yeah,
so one, you rightly pointed out about the geopolitical conflicts at various quarters. We are seeing these conflicts, and in September, we saw global crude oil prices declining sharply. From July average global crude oil price was above $80 per barrel. Now it's around $73 per barrel. But now we are expecting again there could be an uptick. So there are some pressures putting the oil prices down, like the weakness in China and the subdued global demand and excess supply by OPEC plus countries.
Right.
But on the other side is the escalation of conflict. So one challenge certainly is the volatility in oil prices. And we know that this is a very critical input which goes into the inflation forecast. RBI has certain assumptions about what is the global crude oil price. For example, currently the assumption is $85 per barrel.
Right.
So that is one. But domestically also, what has changed from the last MPC meeting that was held in August is that we are seeing signs of slowdown in various high frequency indicators.
Yeah.
One notably is the bank credit, because the key drivers of bank credit we've talked about earlier were personal loans and services, and now we have seen that these two indicators are showing a decline. Part of it is certainly linked to the regulatory prescriptions that were introduced by RBI late last year.
On unsecured lending.
And also lending by banks to NBFCs.
Yeah.
And now we are seeing that impact. Personal loans is coming down. Bank lending to NBFCs has seen a sharp decline. But it also perhaps could be a signal of weakening demand, particularly urban demand,
right,
which we also spoke about during our GDP discussion, that while rural demand looks good, urban demand shows sluggishness, and that continues even looking at the conventional high frequency indicators like the vehicle sales, petroleum consumption, PMI manufacturing. We've seen that there has been a consistent slide. So there are these initial signs of weakening growth impulses at a time when oil prices are showing signs of volatility, which could have an impact on commodity prices and so on. So these are the fresh set of challenges. The growth inflation trade-off has become more serious, become more pronounced for the new external members to watch out for.
And in fact, Axis Bank, their economy team,
Right.
it's led by Neelkant Mishra, who's also a part-time member of the Economic Advisory Council to the Prime Minister. They came out with research showing that companies recently, they've been using a larger amount of their operating cash flow to pay off their debt, because interest rates are high, the debt is increasingly becoming very expensive for them. So they'd rather use their money to pay it off rather than make fresh investments. So this also then is a cost to the economy, that they are not making investments because they're using their cash to pay off their debt, and that's a consequence of the high interest rate. So all of this comes with a cost. It's not just that we want to bring inflation down and there's no other ramification to it. And okay, so now we have some audience questions. Saurav asks, he says that RBI follows the inflation targeting regime, whereas the US Federal Reserve, for example, follows a dual mandate regime, where they look at growth and inflation or employment and inflation at the same time. Which is more effective, he asks?
So see, US officially, they are not inflation targeters, but they have adopted certain elements of inflation targeting regime. Particularly from 2012, they have an inflation target which is 2% in terms of the personal consumption expenditure based inflation. So they are looking at PCE inflation, and they are also looking at a 2% target. So while officially they don't classify themselves as inflation targeting central banks, but they are following some elements of that. The other thing that they look is the employment. So they want to have full employment along with a 2% inflation.
Right.
Whereas we are following what is called a flexible inflation targeting regime, where we have an inflation target, but at the same time, if you look at the text of the law, it says keeping in mind the objective of growth. Yes. So it's a flexible inflation target. So we are looking at two things. We are looking at inflation, keeping in mind the objectives of growth. The US Fed is looking at inflation alongside employment. And their emphasis keeps on changing. For example, currently their focus has shifted more to the labor market because there are these signs of cooling weakness in the labor market, and inflation has been consistently moving towards the 2% target. So their emphasis keeps on changing, but for all practical purposes, they are inflation targeting central banks.
Okay, and I see. And now Abhinav says that with 90% of our workforce being informal and the monsoon still the biggest factor affecting rural demand and food prices, the impact of RBI's interest rate changes is often debated. By when and how do you expect this narrative to change? And will that make our monetary policy more effective and inward looking than it probably is right now?
Well, I think the question is related to this debate about whether the target should be in terms of overall inflation, including food, or it should only look at core inflation. So that is...
And also should we follow the US Fed, say, example, that they have cut rates, and because of that, should we also cut rates?
Yeah, so there are these two parts to this question. So looking at the first question, monetary policy cannot influence the seasonal spikes in food inflation. That is true. But the fact is that the CPI basket has a major component of food. And the other important element is that, the food inflation is something that is most important determinant of household inflation expectations. So if food inflation is high, if households perceive that food prices are going to be high, their inflation expectations will be high. And therefore, if they perceive that inflation is going to be high, they will demand higher wages. And if wage inflation is high, it will feed into non-food inflation. It will feed into cost inflation. It will feed into core inflation. So there are these channels through which high food inflation will ultimately show up in core inflation. The lag may be different, and there could be various factors that could suppress the core inflation. But given that food inflation primarily determines the household inflation expectation, it is not it's not advisable for RBI to completely ignore food inflation. They have to, but of course they should look at overall inflation, and at the same time they should look at core inflation. The other reform that is needed is that, now we should readjust our CPI basket, because now we have the consumer expenditure survey findings with us. We know that the share of expenditure on food has declined. So that will help us giving us a more accurate picture. We see from news items that, CPI base year is going to be changed.
Yeah, to be fair, the government is working on it.
Yeah. So we should have a more realistic assessment of inflation. But if we say that, if we only focus core inflation and we tell to households that, inflation is 3%, whereas households are reeling under high food inflation, it will erode the trust and credibility of RBI as an inflation targeting central bank. So it is important to look at overall inflation as well as core inflation, and also look through the seasonal spikes. It's very important to do that also. If there are these temporary spikes happening due to seasonal factors, then we look through that and focus more on structural issues. But we need to look at both headline and core inflation. That is one part of the question. The other is US inflation cutting. That has, implication for our exchange rate. So if RBI does not cut interest rate, it could lead to widening of interest differential, leading to propelling of capital flows into the market, having an exchange rate implication. Rupee will get stronger because now we see that Indian rates are elevated, US has cut rates, so there is more profit in borrowing from US and investing in rupee. So there could be a flood of foreign capital into India and other EMs, and how RBI responds to that will determine the implication. So along with inflation, if we start targeting exchange rate, there will be a problem. Again, we are back to the impossible trinity. Whether our monetary policy is independent or not, those are debatable questions.
Right. So there you go. We have a new monetary policy committee. They have a challenging 4 years ahead of them. Hopefully, not all of the 4 years are going to be this challenging, but right now, they've got a lot on their plates. There's a lot that's happening in the Middle East area. There's things happening in the Chinese economy. all of these have implications on commodity prices, especially oil prices. India imports most of its oil, more than 80% of its oil requirement is imported. So, what happens with global oil prices affects inflation in India, and the MPC has a target to meet. So, all of this makes for quite a tough job for them to do. But on that note, that's all we have for you.